Our understanding of financial markets as retail traders is fundamentally wrong in many ways. Most of us base our assumptions based on news reports and various analysis. Most of those analyses are essentially technical and fundamental analysis. Technical analysis means it's based on certain logic and rules, uh, based on how the market moves. And unfortunately, there is no or little scientific basis for how those rules are built. So when your analysis, when the stock actually doesn't work as per the rule proposed in a technical analysis, you call that as bad luck. But unfortunately, it's just a speculation. It's just gambling. Fundamental analysis, on the other hand, is still has certain logic to it, because you're basing your valuation of the company based on how the company actually operates in reality. But unfortunately, financial markets are a complicated system, and they just don't factor in how the company behaves, how the company moves. But they also react, and it's this reactionary nature of financial markets which reacts to various events, various news, how the competitors of that company might move, how the government regulations might come in place, how the macro factors are going to play in future, which makes financial markets extremely difficult to study. In fact, so difficult that people have tried to study financial markets in a more scientific way. A more scientific approach to this was made by economists, and it is still done. There are various economic models which try to explain how financial markets behave and why they behave in the way they do so. But most the fundamental flaw of these approaches is that they assume markets to be in a mode of equilibrium, and their uh, analogy is essentially derived from how natural sciences like physics, maths, biology function. So they assume that such laws of nature can also be can also be generated for financial markets. Unfortunately, financial markets are man-made. It's not a natural system, and the more important part here is they are reactionary in nature. So when you try to study, say, a particular parameter in a financial market in a very scientific manner, without going through any preconceived notions, and there is any disturbance in that system, any kind of reaction uh, is generated into the system, the parameter under study itself changes fundamentally. So that makes it extremely difficult to actually study the true nature of financial markets. A recent attempt has been made. By recent, I mean in the past couple of years, maybe in the past decade or maybe 15 years. A more scientific approach has been adopted to study financial markets. It's called quantitative finance or financial engineering, where people from various scientific backgrounds, like top level mathematicians, physicists, they have tried to understand how financial markets behave. And what they do is base their understanding on the basis of certain frequencies and asset classes. So they understand that the true nature of financial markets is extremely difficult. It's and the and trying to come up with any one formula or one law is futile here. So rather, they they understand that financial markets cannot be studied in cannot be understood in totality, and it's much more efficient. It's much more useful to break down this complex system into different frequencies. Frequencies can be like microseconds or nanoseconds. It can be something like days or minutes. It can be something like weeks, months, or even years. And based on these different frequencies, an attempt is made to understand how the markets are behaving and how we can come up with certain models of good amount of approximation that can emulate those behavior, and as a basis we can generate some sort of useful trade in these systems. These are called uh, quantitative financial models. Um a very renowned portfolio manager once told me that somebody who truly understands financial markets will always tell you that they truly do not understand how the markets behave, and there's always a high level of skepticism. So somebody who truly is a successful fund manager, consistently earning money and generating returns for the investors, will never admit that they understand financial markets truly, because that's the reality. They are just trying to come up with good amount of approximations, and even after all the efforts put in, all the scientific approaches adopted, they still understand that things can always change. So there is always some amount of skepticism, there is always some degree of um skepticism associated with their understanding, and it's this maturity, this doubt, that makes them good fund managers. To differentiate between how an economist and a true financial engineer or a quantitative finance expert differ in their approach, economists, there are many economists out there who have been Nobel Prize winners, and they have tried to explain the markets, come up with their own laws. Unfortunately, very few economists have actually gone on to become successful fund managers. That's the reality. 99% of Wall Street is currently led by PhD physicists, PhD mathematicians, and likewise astrophysicists, people from NASA, uh, companies like Tesla, uh, Microsoft, Google. They all come here and they try to do their part, but that's the basic difference. So, what you should ideally do as a retail trader, because you don't have all the knowledge that would be required to actually study financial markets with a good amount of approximation. So what ideally you should do is try to come up with try to look at these various reports that are out there, not just the fundamental and technical analysis, but also develop your own intuition as to how financial markets are supposed to behave. Maybe look at how the equilibrium models, as proposed by many economists, are work do their estimations of the markets, and try to understand how the markets are supposed to behave as is proposed by these different models. So you don't need to look at the nitty gritties of how these things work, but you can at least get a flavor of it, get a taste of how these things work by using maybe various LLM tools, various uh, various AI tools like ChatGPT, DeepSeek, Gemini, and you can at least understand how financial markets truly behave, the true nature of financial markets are supposed to be. So basically, the point is to introduce certain degree of skepticism, certain degree of doubt in your mind, so that you don't operate with high level of risk in your investments, and you follow a more balanced approach. Remember, skepticism and doubt is always can only arise in two situations. One, when you are absolutely uh, confident about how the system functions, and you are sure that you do not understand the system perfectly. And it can also arise in a situation when you do not understand anything at all. So the confidence in the fact, it's always better to confidently understand that you do not understand everything perfectly after going through some of these methods and approaches, and then place your bets accordingly. Introduce certain amount of degree of risk aversion in your approach, and then translate that risk aversion in the form of appropriate checks and bets in your trade. So that's something that we all should do. Do not base your trades blindly on the basis of these analyst reports that you get to see on the news and reports. It's highly risky. It doesn't hold true in most of the situations, and it has no scientific basis at all. So please be aware, it's your own hard earned money. uh, Take care of it.